round 7, a quick review. At this point, I shouldn't need to go over things too much. A couple things to point out, though, I think they're kind of interesting. So, sales, again, dominating the market. Andrews, what's that? A total of 43, almost half the market with one company. So that is pretty impressive. And ROE 27.4. Erie's ROE 16.8. That's nothing to sneeze at. Any investor would be pretty happy, if a company could consistently put out that ROE. Saw, disturbing drops here in contribution margins, really, it seems like, from last round. Other than Andrews and Erie managed to maintain theirs. And so, I don't know if companies were endeavoring to sell more, and so they might have lowered their prices. I see some huge increases too in the SG&A margins. So I don't know if they spent more, if they were doing things to really try to push sales. If so, it looks like those efforts might have been somewhat ineffective because we didn't see sales, so especially for Baldwin or Digby, improve. I think they're actually down from last round. I'd have to go back and check. Ferris actually turned a profit, so good for them. They kind of came back and at least became profitable. Stock market summary. Again, Ferris. How many times do I have to say it's stupid to sell stock, and it's even stupider to sell it when you're at $1 a share? Sorry if I'm a little bit blunt there, but you're raising a little bit of cash. We can come down and look at the cash flow, but it's insignificant. Okay, $788,000. Really, it's insignificant. And all it's doing is diluting your stock base, just hugely diluting your stock base. And in the real world, that would be a horrible maneuver. Okay, it's a sign of desperation for some companies. There's no question that some companies will do that as a sign of desperation to raise capital. But you guys weren't really needful of that, as you did have, a profit this time. And so it could have probably generated that capital, on its own, or taken advantage maybe even of some bond markets, or borrowing otherwise in the short term, other than the bond markets. Again, we see Andrews pretty well taken off. I don't think I'm keeping anybody in suspense, but I think it's a kind of a foregone conclusion who the victor is again this time. You see, still making huge plant improvements. Okay, buying back stock at a prodigious rate. Digby sold some stock too. Again, don't know why. Not using long-term debt at all. Not really using current borrowing, although at least Ferris did use some current borrowing here. Okay, and really had plenty of cash. Again, no need for the $788,000 and the fees and costs that are associated with issuing that. Okay? Can be reasonable. I mean, they're relatively high. Dividends, we see that Chester paid a dividend, so but also had a small emergency loan, but rather small, and no other team had an emergency loan, so that's good. Not a ton of cash really for this point in time, at least for these 5 teams, which is good. I think that's good cash management, actually. Andrews, all kinds of cash, but generating lots of cash flow and maybe finding it difficult. They're probably buying back about as much as they're allowed to. Could certainly start paying down some more long-term debt, which they have, $94 million of that, or start giving it back to shareholders. This amount, of cash, keep in mind that makes it a little more difficult to get an ROA, which isn't that big of a deal, but can also make it a little bit more difficult for an ROE, right? Because their total equity's way up here. Now, if they use cash to pay down debt, their equity position doesn't change, so their ROE wouldn't change. But if they used cash for other things, again, buying back stock or paying dividends, they could improve their ROE. And their leverage is that might be a good question. Their leverage is still very small, 1.3 or something like that, 1.4. Okay, so they could stand to reduce their cash quite a bit and still keep their leverage reasonable and thus improving their ROE. So I shouldn't give them ideas, maybe. They're the winning team. Other teams to attempt to be victorious are going to have to do similar things. They're going to have to go small, is what I would call it. Erie, for example, here had pretty good sales, pretty good ROE, but Erie, 18.6 million and really no debt, other than accounts payable, which is just a yearly amount of debt, could sure do some things to reduce its equity, okay, easily, incur some debt, buy back some stock, pay a little dividend, go ahead and leverage up a little bit. And again, Erie could stand to leverage quite a bit. Their leverage ratio's got to be really tiny. Yeah. Okay. They could leverage up quite a bit to get their ROE up substantially. Okay. Again, it's I know that we live in a world, and believe me, personal debt I think is horrible. But debt, and let me rephrase that, personal debt for depreciable assets is horrible. Debt that's for investment, either business or personal, I think can be effective as long as it's not taken out too much, as long as it's not too risky. Okay, and we've been all the teams, even including Andrews, have been fairly reticent about their leverage, and I've kind of preached that, I know, throughout this thing, but leverage is a real tool that's used in the marketplace, and it can give you competitive advantages. Now, it's nice, you're risk-free if you're out of debt, and there's a lot of companies, big companies, that are out of debt that seem to be doing just fine. And so, there's arguments for that, certainly, but in a growing, here's my argument is that here, especially because we've got a fast growing, and we knew that when we did our situation analysis, we had this really rapidly growing industry, okay? It was projected to grow at, 14% per year, okay? To borrow money, if you can borrow money at even that rate or less, makes all kinds of sense. It just makes all kinds of sense, to lever up as much as you can. If your rate's a little bit lower, makes a tremendous amount of sense. Okay, and again, part of that is that your return, that 14% growth, is compounded, and your payback is not compounded. And so, that's why I say you can borrow at the same amount or even a little bit higher and still really be effective in terms of creating a return on equity for your shareholders. Sales, amazing sales there. A little bit of inventory, but that's decent inventory. Maybe a little more here in Alice than they wanted, and we might be able to take a look at why. At a glance here, when I looked, Baldwin had low sales. I can look at their ages here, on the traditional side even, and say, 4.5. They want to be by 2, right? And low end side, they're actually a little too young, especially bead, but these ones are too old. Now, I look here, and it looks to me like Baldwin maybe, because their products are really, really out of position. Maybe they made some decisions to try to reposition them, but they're actually, this one isn't going to reposition until the game's over, right? 2025, and we're in 2023 this year, and be 2024 next year, and so might have gone a little too far on their R&D. It looks like they let it slide for too long, and then tried to all of a sudden make it up in one round, and got out a little bit too far. I think E4 down here maybe had the same issue, although maybe E4 is a new product. I'm not sure. Okay, you look at Digby too. Here you got a high-end product that's 3.5 years old. You got Dot, which didn't even know where Dot was and didn't sell any, and still has 749. And if you look at the perceptual map, it'll be pretty easy to see that it's just out in outer space, basically, with a 5.2 year. And so, you're not going to sell them if they're not at least within the dotted circle. on the perceptual map. And even then, if you got lots of competition that's within the inner circle, it's going to be difficult to sell it. And I think that's what we'll see there. So Erie, I'd be concerned when I looked at this that maybe Erie gave up some sales. We'll see that. Ferris coming along a little bit better. I'm still really having troubles with contribution margin. Just not investing the kind of money that you need to keep the cost down. Look at the differences here. Labor cost, $1.37 on its high-end product. Okay, really, really low. I have not seen that in the high-end product, and it'll be lower probably next round. I've seen low-end products, and they're up to the max here now in automation, and they've maxed out in a few other areas. I've seen low-end products get down to below $1 actually in cost, and maybe they'll get there next round. I don't know, but not the high end. And the reason it's different now, they started aggressively in the high end. They were a little more aggressive in getting their automation and stuff going. Cruise down a little bit through these. Met demand. Yep, Erie gave up a ton here. Look at that. They sold about 9%. They could have had about 27-28%. So it looks like they gave up about 20% of the market here in the traditional segment. So that cost them big time. Conceivably cost them the round, or at least in terms of ROE, they certainly could have done a lot better. And days is their product there. It's right there. So it was even out of the loop, and maybe that's why they didn't think it was going to sell so well. It was a high age, but they got Dixie too. So my guess is Dixie. I don't know why maybe Dixie didn't sell any in the traditional segment, even though it's right there on the line, but sold a bunch maybe in the high end. Is that where it competed? Oops, I'm sorry, I'm going to cruise down here to the high end and see if Dixie sold there. Just 186, so I don't know what Dixie's problem was. I'm guessing, and we'll have to go down and look, I guess, when we get down there. Hopefully I'll remember to take a look and see if that's what Dixie's issue, sorry, I'm scrolling back and forth, if that's what Dixie was the product that they could have sold more of here. And maybe they just didn't make it. I'm not sure. That's kind of interesting. Dixie shows as a high-end product. 220 left in inventory, so it wouldn't have been Dixie. And Days had some left in inventory. So why did it have that kind of potential? Oh, I'm sorry. I'm looking at, gosh, Erie had the potential. I'm sorry. Oh, the heck. Eat. Okay, and Eat did sell out. Okay, and they sold 906 units. Now what I want to see is, did it have, it had the ability to produce 2,000 units and could have easily sold all of those, it appears. Easily could have doubled its sales there. Had a nice 35% margin. So it could have sold another 1,100 units at $26. So what's that, it's almost $30 million in sales at a 35% margin, so about $10 million in before tax profits that Erie gave up just in that one product. So interesting. Low end, sorry, Andrews actually gave up the most in the low end there. Could have had about another 10% of that market share. And it had 25% of the market share, so could have done that much better. Spending a lot of money, a lot more money than the other teams in promotions and sales. Again, even so, its percentage is down, but once again, it's because its products are positioned properly. As you go through some of these, you'll just see products out of position, that then just aren't selling as a result of that lack of positioning, I guess we would say. High end, just dominated by Andrews. Erie gave up some there though too, right? Good 5% or so. Performance. Alice might have got a little, we talk about positioning and kind of getting out of your head of the curve. Alice might have got a little too far out. It didn't sell out, and it's outside though, and would have been, okay, would have been outside the black inner circle. Maybe um, for a good part of the year. Okay, and so maybe it didn't sell quite as well as it could have, simply because it was, maybe a little too aggressive, a little too new. Age, good low age, had everything else kind of going for it, but might have just gotten a little too far ahead of itself. Size, again, dominated by Andrews. Here's one thing I found interesting. I screwed up. I didn't need to look up the Dixie, but I found interesting here, and we'll get to it after we look at the perceptual map. Um, this one might have been a little too far out of position too, but I'm guessing here in the size segment that the competition just wasn't there, and so Donkey was able to sell pretty good there. But Alice and Aha might have been a little too far out. Look at this. Andrews had by far the largest sales. Okay, at least double of Chester's, right? But Chester had to have twice as many people to make those. Okay, and people are expensive. People have turnover, 10% turnover, so you got 100 people, you got 653 new employees. That's expensive. And why is that? Well, part of it's right here in the HR. Okay, 126% productivity versus 112% productivity. If you went up and looked at the automation, you'll see that now, anyhow, Andrews has completely maxed out on automation. So guess what? Fewer people when we're automated. Fewer people when the people that we have are productive. And then lastly, you go down to the TQM, and we'll see there that Andrews made max investments. Actually got a little overboard this time. I'll tell you why. But max investments there, which again is a huge labor cost reduction, versus Chester, virtually no labor cost reduction. Okay, so look at that, just the number of people, twice as many people to produce half as much product. An interesting phenomenon, isn't it? And that's frankly why you see companies in the real world too automating to a great extent. Okay. Here's what I said, Andrews. I think look at there, they spent again $1.5 million in each category, but they didn't get any marginal or nominal benefit from that. Erie spent $1 million per category. Okay, both of these teams were kind of maxed out last time. I'm not sure that any of this money was real effective. I'd have to go back and look at their TQM from the year before, because I don't know that they achieved any more benefit from this kind of an investment. And you can go back and take a look and see if they had any benefit. It's probably marginal, and it kind of tells you when you're making your decisions. At some point in time when you kind of max out what your overall investment has been, cumulative investment has been in each particular category. And my guess is that both these teams have maxed that out. Okay? Which again gives them even more advantage than going into next year, because they wouldn't have to spend any more money in this category, and they've already achieved the full benefit that they're going to achieve. And that's kind of it. Again, a little fairly quick. Probably get one question out of here regarding the ROE again, and the leverage and what we can do with that, what Erie might have been able to do to get an ROE similar to that. So similar to some questions we've done in the past. Not a huge surprise here. I'll kind of go through quickly the winner spreadsheet. Hopefully I get the right one this time. Look at that, perfect score for Andrews, so darn good. Erie, a perfect second, you could say. Okay, took second place in every single category there, and so that's a perfect second, I guess you would say, but a perfect score for Andrews, so I have to say congratulations to them. One round to go. They're going to be tough to catch. There might be some possibilities that some teams could do it with proper financial management, so good luck to you guys in round 8.